All right, folks. So welcome to Investing for Beginners podcast. Today, we're going to have a fun show. Today, we're going to continue our discussion of the pivot framework. We have recently talked about portfolio management, P, I for idea generation, I, V for valuation, our favorite. And today, we're going to talk about O, which is observe metrics. So we're going to share with you 3 different levels of metrics. We're going to stay with us to the end because we will reveal why these are important and how you can learn from them, even if it, air quote, might be a little bit over your head. So with that, let's dive into the first one, which we consider more of a beginner level, and that is gross margin. So what are your thoughts on gross margin?
Gross margin, or margin in general. Margin's short for profit margin. And so what you're trying to do is, in the way you look at companies' profits, because profits is important, right?
Mm,
If you look at most stocks over a long period of time, the stock price follows the profits per share, earnings per share. There's studies about that. People have written about that. So in the short term, the stock market's crazy, but in the long term, it tends to follow profits. So we want to analyze those profits so that we can understand a business, and we can understand, is the business getting stronger? Is it getting weaker? You want to, if you can, and hopefully the longer you do this, the better you get at it. But you want to take second level analysis. You don't want to look at just, oh, okay, they grew by this much this quarter or this year, and so that's the extent of my analysis. You want to look at deeper things that would hopefully tell you how a company is going to do. Like, I hate to use this example because I have a family member who I love dearly who still owns the stock, but Target got destroyed today. And luckily, I don't think he listens to the show, so we're good. Target got destroyed today and is down like 15% or something. And I used to own Target and I got burned, and it was not pleasant. But one of the reasons why is people look at Amazon and Walmart and how strong those businesses have been performing. And then you look at Target and it's not as strong. So you can use changes in margins and all of these things to show how a company is getting better versus its peers or not as good. And so to me, that's one of the main, not, I wouldn't say main, but it's a big way to utilize a metric like gross margin, because you can use it to determine, how it's doing in the marketplace.
yeah,
But that's not the
exactly.
only way. Yeah.
Yeah.
How do you look at it?
Well, I look at it as, I guess I look at it in a combination of, when you look at the income statement, you have 3 main margins you can deduce from there: the gross margin, the operating margin, and the net income margin or earnings. And the gross margin is probably one that probably gets maybe the least amount of love, if you will. And there's some definite takeaways you can pull from the gross margin that can give you some insights into, I guess, how strong or how weak the company is. And the gross margin is a great tool to compare others in the same industry. You can compare it. So you can compare it to others in the same industry. So you could compare the gross margins of Google and, let's say, Meta. And you may not think, they're not quite the same, but it gives you a base point where you can kind of compare. So if you're analyzing Google and you want to buy Google and you see that their margins are dramatically worse than Meta's and they're in the same industry, that could make you dig deeper. Like Andrew was talking about, the second level like analysis, instead of just looking at the number, the top number, dig into why it is. And that can lead you down a lot of different paths to try to determine what's really driving that. And when we think about gross margins, what we're really thinking about is you're comparing the revenue of the company to the costs of producing whatever it is they sell, whether that's a physical product or whether that's a software or whether that's some sort of service, whatever it may be, all the costs that go into producing that. So, the people, maybe the raw products that they have to buy and different things associated with that. That's really the top line profitability. And if a company isn't generating profits from there, then the rest of the income statement is going to be an absolute disaster. And, I'm looking at you. Oh gosh, what was that company? Beyond Meat. This is a perfect example of a company that's not making profit from its main costs of doing business. And when you see something like that, run far, far, far away. But when you, kind of turning it back to Google, that's one of the things about Google is you can see is you not only compare, look at how great they're doing, but then look at their historical averages to themselves, and then compare shorter periods, 1, 3, 5 years, 10 years, and then see if any of those are growing. And those are all great signs when you're trying to analyze a gross margin, and it can be very helpful to determine how strong the company is.
Yeah, for sure. What's your take on like a flat gross margin?
What's my take on a flat gross margin? I think it depends on, I think it really depends on the business. So, give you an example. A company like Costco would probably have flatter margins simply for the fact that a lot of their revenue growth is driven from their subscriptions. And if they go 7, 8, 9 years without raising their subscriptions much or at all, then some of their gross margin might be flatter. And it also depends on how they control their costs and whatnot. Now, I'm just kind of talking off the top of my head. I may be completely wrong about that, but that's kind of my perception. I think it indicates some stability in what they're doing. You also have to take into account what's going on underneath the hood, if you will, as far as when you're looking at the costs that are associated with that. So, for example, we're all going through this higher inflation in the United States. So the costs of raw materials are more expensive. So if they aren't raising prices, or if they're raising prices to keep up with the rate of inflation, you might see flat margins. So I think you have to, I try not to assign like a negativity to that, but I try to dig a little deeper and understand what's driving the flat margins. Now, having said all that, I want to hear your thoughts.
I feel like you narrowed it down pretty well in that, pricing power plays a big role in gross margin. So to your point about the inflation, if a company can't raise its prices because it has no pricing power, but its costs are going up because inflation's hitting them, the gross margin is going to go down. It's going to shrink. You don't want that. If their prices are at least keeping up with inflation or just their cost base in general, then you should see that flat. So you would want at least flat. My thought is rising gross margin is nice, but it has a limit. You can't raise above 100%. You can't have negative costs. At least in today's version of businesses, we have not seen it. So
No, not yet.
I'm perfectly fine with flat margins. I think it's good as long as the business is growing.
Mm-hmm. Yeah, I agree. I mean, I think it's a great place to start when you're starting analyzing a company, is to look at the gross margins. It's at the top of the income statement. It's easy to calculate, and it can tell you a lot about a potential moat, how it compares to other companies, pricing power, and so it could be very useful to learn all those things.
Any easy ways to visualize gross margin for people that they can do?
Well, as far as like calculating it,
just like if I wanted to look at 3 companies' gross margin, over a 10-year period or something.
Right. Well, I mean, the way I would do it would be to go to our friends at finchat.io, and they have the ability, they have a function there where you can compare companies' gross margins right in the same graph. So you can see, how is Target, Walmart, and Amazon, you mentioned earlier, how are their gross margins across the board for all 3 companies? And so that's a real easy way to do it. And that's the way that I would do it.
Yeah, I did that with home builders, and I liked what I saw, but there's also been other times where I didn't like what I saw. So
right.
it's definitely a good tool.
Yes.
And I kind of want to go and look at Target now. I'm just curious, but
right.
we'll have to say that
Yeah.
another time.
Yeah. After we get done, I'm going to be like, so why exactly did they get spanked so bad?
Right.
All right. So I guess kind of building on that, let's talk about like our next intermediate resource or idea, which would be the current ratio. What are your thoughts on the current ratio?
So current ratio is a balance sheet one. So we talked about income statement. Now we're in the balance sheet. The balance sheet, it's helpful for multiple reasons, but a big reason why you want to look at a company's balance sheet is because safety matters. You want businesses that are low risk. And even if even if you buy a business that's higher risk, and let's say things blow up, I put that in quotes, things blow up, but the business doesn't go bankrupt. Shareholders can get absolutely huge losses from a bad balance sheet. So I feel like I've been talking about home builders a lot today. I don't know why, but if you look at Pulte Group back in like 2002, 3, 4, 5, they had kind of that classic case of not the greatest balance sheet, took a lot of risk, yada yada yada. Obviously, they're still around today, but if you're a shareholder at that time, they had to issue all this equity, and so when you issue equity and you make that pie, your slice of the pie gets smaller because they're handing out all this stock to Wall Street. Your stock price just falls off a cliff, and that's exactly what happened. So a strong balance sheet protects you from a company having to take out a ton of debt when things go bad, or having to raise a bunch of equity to have fresh cash that now you're diluted and you've lost years of compounding. So looking at balance sheets and finding companies with strong liquidity, strong solvency, liquidity just meaning they can pay off their short-term debts, their short-term liabilities. That's how you decide. That's how you can kind of see the safety of a business model, and the current ratio is a great way to do that.
How do we calculate the current ratio?
Quite simple. So in the balance sheet, you have the current assets, and then you have the long-term assets. You have the current liabilities, and then the long-term liabilities. So you just take the current assets, you divide the current liabilities, and that number will give you a current ratio. Anything above 1 is generally considered pretty good. But companies will go below 1. Sometimes they have other financing, short-term financing that's available. Sometimes they just turn over inventory so fast that they don't need it to be right at a 1. But yeah, that's kind of how you calculate it and some of the ranges.
Yeah, that's right. Do you find that current ratios will differ a little bit depending on the industry? Like you've had a fascination for the home builders. So do they generally have different current ratios than, let's say, the auto industry?
Yeah. The home builders is tough because they don't actually break it out between current and long term. So you kind of have to use your discretion when you're doing that. One that I think is kind of telling is the retailers like Costco or Home Depot or Lowe's, or grocery stores is another one, because they're turning over so fast. And Target, we are talking about Target, right? They have a pretty low current ratio too. Turning over things so fast that their business seems to function fine without needing to have all the cash ready all at once. So if if Target's selling bananas, I feel like you and I have had this conversation like
yeah,
a couple of years ago. If they're selling a bunch of bananas, I don't know if you like net 90 that to the distributor or something, but
right.
Yeah, you're getting a lot of cash quickly, and you're selling a lot of bananas, and then you can continue to repeat that week after week after week. So you don't need to have your whole year's worth of bananas paid up, if that makes sense.
Yeah, it totally does. Are there any red flags when you're looking at a current ratio that, like, would you want to look at a current ratio over longer periods of time, or is it okay to just take the one snapshot that you see from the particular balance sheet you're looking at today?
I think more data is always better. Not always, but usually. So yeah, you can look at it over a longer period of time with the understanding that sometimes a current ratio that's getting less good is not a bad thing. So now we can start talking about super complex things, but like companies that optimize their working capital to free up free cash flow as a way to finance growth, they can actually have current ratios that get worse over time. I personally like to use it just as a snapshot, just so I get an idea of, is this company solvent or not, or can be liquid, but with the caveat of kind of like you were you were saying like different industries can have different ones. So if I'm not sure if this is a good current ratio or not, maybe it's a good idea to look at their competitors. How does it compare to their industry? And that could be helpful.
Yeah, for sure. I think one thing to mention when you're thinking about a ratio like a current ratio is the balance sheet is a snapshot in time, in that it's a 1 day look at the particular company. So what may happen the next quarter, it may be different. And to Andrew's point, when you're analyzing the current ratio, it's good to look at it over a period of time, and you can see you will see fluctuations from time to time depending on where the company is in the cycle of inventory. For example, when we're talking about retailers, they'll have periods of time where, depending on how the cycle lines up, they may have more in inventory or they may have more in accounts payable, depending on kind of where they are in the cycle. And as you get closer to the holidays, for example, you may see a buildup in inventory, and you also see a buildup in accounts payable because they owe more money. So it will evolve. But I love the idea of using it as a kind of a snapshot or a way of relatively quickly analyzing whether this is a stronger balance sheet or not. Because to Andrew's point, if the company can't pay off its short-term liabilities with the monies that they're generating now, that could be a sign of a bigger problem to come.
Yeah, for sure.
All right, so let's move on to the expert level conversation, and this is a metric that we love to talk about. So this is ROIC, or return on invested capital. Would you like to take first serve?
Sure. Return on invested capital is trying to measure how well a company reinvests its profits, essentially. So higher return on capital means that when a company makes an investment for growth, that they're getting more growth rather than less growth, and not just revenue growth, but profits growth. And so that can help you find really capital light businesses, or businesses that don't need to reinvest as much in order to grow. And that can be a great place to have compounding. Because to the point about the gross margin and the inflation that we talked about earlier, when inflation's really high, not only is that hard on your income statement, but now when you reinvest for growth, that fleet of trucks that you gotta invest for are now much more expensive than they were the year before because of inflation. And so it's like, it's hard to grow because it's so expensive. But when you have a company like Costco or Google that have really high ROICs, they can grow and not need to invest as much because they have such strong businesses. So it can be a great way to identify good potential opportunities. It can also be a great way to analyze how well a company is investing for its growth.
Mm-hmm. Yeah, exactly. And no matter how strong a business is, no matter what company out there that you think is the greatest one ever, they all have to spend money to grow. They all have to reinvest. And the ROIC metric is the easiest way that I know of to measure the effectiveness of those reinvestments. And the higher the number, the better. And if you see companies that have low ROICs, chances are they could be destroying value for investors, because capital allocation is job number one for every CEO. And if the company is making money, they have to figure out how to spend that money wisely so they can continue to grow, not just for themselves, but us as the shareholders. And the ROIC can be a way of measuring how good the business is and how good the management team is, like how well they spend the money that they make. And it's a real easy way to, at a snapshot, see kind of how a company is doing. And there's other parts of the ROIC that I think can be very beneficial to investors to kind of get in better insights into how well the company creates assets and how well they use those assets to grow. So maybe we could talk a little bit about like from a 30,000 foot view of how to calculate ROIC?
Sure. So it's basically a metric for profit divided by a metric for invested capital. That would be the biggest 30,000 foot view. We talked last episode about some of the problems with using straight up earnings or the PE ratio. That was the valuation episode. So if you haven't listened to that, go back and listen to it because it was fire. I'll be honest, it was fire. But because it has those issues, the earnings can have issues where it's not always a good metric every year. Then you need to use a NOPAT, which is the looking at a more stabilized, more operating part of a company's profits. And then invested capital is really measuring those reinvestments that you talked about. So like what are examples of some of those reinvestments that end up showing up as invested capital?
Well, there's a lot, but two of the probably easiest ones for people to visualize would be something like inventory. So we were talking about retailers. So if we think about Costco, they sell physical products. And so to buy my favorite green olive stuffed with garlic and jalapenos, they have to go out and buy that from a vendor and stock it in the store. So Dave, when he walks in, can buy a whole bunch of them. And the money that they spend, it shows up on the inventory, and that's an investment because they have to have that to sell to me. So that's part of it. And then you could think of something like property, plant, and equipment, or capital and expenditures, or capital investments, or whatever term a company decides to name it on the balance sheet. Really, what it is those are investments as well. Though it can be as simple as buying, maybe not simple, but it could be as simple as buying another warehouse. It could be buying office chairs. It could be investing in software. Maybe they're investing in software for their inventory system so they can track what comes in and what goes out a lot better and streamline the reordering process. That's all part of property, plant, and equipment, or capital expenditures. And those are most definitely investments that any company would be making to continue to grow. Now, maybe a company like Visa doesn't have to spend money on inventory, but they definitely have to spend money on their tech that they try to continue to maintain and improve upon. And those are capital investments. And so all that stuff kind of ties into ROIC. Any other ones that I maybe have missed? Or you want to throw on the pile?
Yeah, goodwill would be one. Like if a company goes out and buys a lot of other companies, they do a lot of mergers and acquisitions, M&A. So they will have goodwill as a line item. And ROIC can help out. I've found, and we'll see if it ends up being a good strategy because this game is played over the long term, right? But I found that like there are some companies that are very acquisitive and they do expensive M&A, and then you see their ROIC just start to plummet. Is that going to work out for shareholders? We'll see. It's not something I'm willing to bet on. So goodwill can be, when you include it in ROIC, it can be a great way to see, to your point about capital allocation. Is a company making smart acquisitions? Are they making sure they won't overpay for an acquisition? That can make its way into the ROIC if it's a big part of their reinvestment strategy.
Yeah, that's a great example. Intangibles is another one that kind of gets lumped in with the ROIC. And one of the challenges with intangibles, if you think about a company like Apple, it has intangibles on its balance sheet, but you could argue that the brand is probably one of the more important parts of Apple's growth. But how do you measure that on the income statement or the balance sheet or the cash flow statement? You can't really. And companies will, that's one of the hard parts about doing this, is that you may look at an ROIC of a company, let's say Coca-Cola, the kind of the opposite end of a tech company, and unquestionably they have a strong brand. It's a name that is known globally, but you can't really express that on the balance sheet. And so you may look at the ROIC of Coke and go, that's not so great. But you have to calculate the value of that brand somehow. You can't necessarily do it through the ROIC per se, but it's definitely something that when you're analyzing a company, you kind of have to look a little deeper than just the flat number of the ROIC. You have to, to kind of have a second order thinking in that what's driving this, where is this coming from, why is it artificially low, like Andrew was talking about companies that do a lot of mergers and acquisitions. A company that I bought years ago was Fiserv, and they went through a big acquisition, bought First Data for 30-40 billion or something like that, and it tanked their ROIC. It's been terrible, but it's been a great investment because I guess I tried to look past that and hope that that hope is not always the best strategy, so just take that for what it's worth. But I thought that they could overcome it and return to more regular ROICs, and that's where they're getting to because they've done a good job of assimilating that acquisition. But that's a rarity, not the norm, if you will. So yeah, it's the ROC is it's a great metric, and I think it's probably one of the, maybe not perfect, but probably the closest that I've been able to come to. But I could be drinking the Kool-Aid too.
Yeah, that's important, right? It's just a tool. It needs to be just one of your tools in the toolkit. I would not recommend just going out and buying every high ROIC company you can find. That's probably a recipe for disaster.
Yes. What is that phrase? Not all great companies are great investments.
Yeah.
So there's a lot that goes into that. And so to your point, yeah, just because it has a really high ROIC does not mean it necessarily is a great investment. It could be, but it's not a guarantee.
It makes me think of the pivot this pivot journey what we've been embarking on, right?
Yeah.
Each pillar is fascinating in its own right, PIVOT, but each of them standing alone on its own, I don't think are as powerful as when you combine all of them. So to your point about a great company is a great investment when it also has a decent valuation. You overpay, you forget the V of pivot, you're gonna learn the hard way that that's a very hard way to invest.
Yes. It could be a very expensive lesson.
Yeah. So what is your, give us the idea, we have the pivot, we have the school of investing. Let's say I have a family member who listens to the show and is like, all the school stuff sounds fine, but I think I want to figure that out on my own. Like,
right.
How do you speak to a family member who maybe thinks that way, and why should they think about doing something like the school of investing instead?
Well, the school of investing, the biggest takeaway is that it helps you learn as you invest, in that when Andrew creates a write-up for, let's say, Google, for example, we create resources that help you learn not just about Google, but then things that you can translate to other investments. So we were talking about ROIC. The deeper and better you understand the ROIC of Google, the easier you can translate it to, let's say, Microsoft or Target. And those are all parts of the pillar of becoming a better investor. And it's not just investment ideas, it's also translating those ideas to the real world. We tend to focus so much on like a textbook or the schoolwork, if you will, when we're at school, but a lot of us, we don't learn how to actually use those resources in the wild. And that's really where the rubber meets the road. It's great. You can understand the textbook example of ROIC all you want, but until you actually see it in action and see how it can impact positively or negatively investments, you're not really going to be able to maximize your returns or have the optimal portfolio or even just grow as an investor. And that's what the School of Investing allows you to do. Not only do you get the resources to be able to understand them, but you also see the connections between what Andrew is creating with his monthly picks, which his money and my money are also tied into. It's also, you get to see how it works in the live, and then you can translate that. My type of learning has always been experiential learning, in that it's all fine and dandy to read something from a textbook and go, okay, yeah, I get it. But then when I try to go translate it to a company that doesn't fit into that neat box, then it becomes way harder to try to determine what is this. I don't understand this. And that's what we're trying to do with the School of Investing is to show you how you can take that, not necessarily textbook, but how you can take the idea and then translate it into, okay, I can use this for a company that's unrelated to what, we're learning about here today.
So correct me if I'm wrong, but basically every write-up. So we've had 5 right now that are featured in the School of Investing, and this is an exciting time because this is a brand new launch
Yeah.
for Value Spotlight with the school. Correct me if I'm wrong, but there are a metric in each of the write-ups. So we had Starbucks, Casey's, Costco. So there's a metric in there that we've specifically highlighted that will be either beginner, intermediate, or expert knowledge basis that you can look at that yourself and say, oh, I can pick out that metric and this is how I can learn it and kind of learn gross margin, for example.
Yeah, that's exactly right. So we take some, metric from each of the write-ups, and then we create in the pivot, we create a overview of the resource, and then we give you a link that you can go and learn more about the metric and how you can apply it to not only the company that's being analyzed, but also taking it away from, so you can go analyze Visa, for example. If you're looking at Google's gross margin, you can go look at it and go, okay, these are the things I can take away and use it for Visa, for example.
Yeah, and I think it's cool that you can drop a comment in each of the lessons too, so you can have someone to check your work if you want. And it comes with the community too, which is so awesome. So I'm really excited about the whole launch. I think it's something that if you've been on the fence about, you should take advantage because we have a special Black Friday sale. I mean, this is going out on November 29th, this episode. At this point, you only have 1, 2, 3, 4 days to lock in this special discount we got going on for Black Friday. So you haven't heard us say that on the podcast before. So if you've been kind of like bouncing around and just kind of consuming things as you go, I mean, that's awesome. It's what we've all done. But if you're serious about making progress in an accelerated fashion and leveraging the experience of other people who have gone before you, this launch with the School of Investing for Value Spotlight would be that opportunity. So I highly encourage you to take it.
Yeah, I do too. This is going to be the best place for you to start learning how to become a better investor. And that's what Andrew and I set out to do 7 years ago. When we started all those years ago, is to try to help people become better investors. And we think this is going to be the best way for you to become a better investor. Build your knowledge, work with other people. Investing can be a lonely game, but with our community, you can talk to other people and pick their brains as well as pick Andrew and I's brains. So you get access to us as well. So it's going to be a great resource. I know I'm excited about it, and I'm learning stuff from it too. So I think it's, I'm trying to build something I think would be awesome for me. So I think that's what I'm excited about.
Yeah, I think that says a lot, and that really comes through in the quality of everything. So that's going to be it for today. I hope you're enjoying this pivot breakdown. We want to thank you for listening and supporting the show. As always, we appreciate all your questions and your feedback. Take action today. Connect, learn, and grow with Value Spotlight. Peace.